We're awaiting the decision from this man and his colleagues, Tiff Macklem, the governor of the Bank of Canada. He could go either way. We heard that from our two distinguished panelists. One interesting thing here is that there's a massive gap right now in bond yields in Canada and the United States. Our bond yields are down 3% and change, whereas America is still well above 4%. And the gap is near the biggest ever. One implication of that could be that people don't see inflation as much of a threat in Canada, and they're holding. They've decided to kick for touch, as they say in rugby. They're not doing it. So Macklem, for example, says he expects 1.8% growth in Q1, but Q2 GDP to be much weaker. Bipan Rai, could I go to you first? No surprise there.
I mean, not so much a surprise. I mean, again, we were at sort of a close call between whether or not they would cut or not. But I suspect that they're paying a little bit more tribute to the rise in inflation expectations that we saw in the aforementioned surveys. Mm-hmm. And also, I mean, judging by what he said at the last meeting as well, when it comes to tariffs, there are implicit costs for businesses as well in terms of sourcing new markets, holding inventories on hand. Again, it feels like in the near term, they're going to be placing a little bit more sort of gravitas there and really waiting to see what the data tells them. But again, a Q2 downgrade does not surprise me at all from Q1.
You're watching the bond market reaction, Ed. Have you seen anything yet?
Not much.
Nothing decisive.
Again, it was a coin toss, so I don't think the bond market really. The bond market expected a coin toss. It turns out to be a coin toss. My guess would be, they were either going to cut, which is I thought what they were going to do, and then speak rather hawkishly. If they don't, they haven't cut. Expect them to be somewhat dovish in their commentary.
On hazards of cutting, the housing market looks pretty weak. I mean, it seems that the risk of another housing bubble may be remote right now, but who knows? But that's always got to be a concern for the Bank of Canada.
Oh, for sure. I mean, certainly we've seen it over the last little while as well. And, there's been talk about bubbles in the Canadian economy for some time now, especially when it comes to the housing market. But one thing to remember as well is that there's a lot of supply side issues as well. And those aren't going to get addressed relatively quickly either. So I do suspect that, to the degree that we are seeing a swoon in the housing market at this point, I think it'll just be that. It'll be a swoon. I don't think there'll be a material sort of downgrade or really a material drawdown in housing prices from here.
When we see such low Canadian 10-year bond yields, barely above 3%, Ed, does that in part imply people aren't worried about Canadian inflation?
Yeah, for sure. I mean, I think that's exactly what. If you look at what's the break-even inflation rates, inferred in the bond market are, well below, the 2, a little bit below, and that should give the Bank of Canada a lot of comfort. So, that they haven't lost the expectations in the market, right? The investors think they've still got their inflation fighting credentials.
Right. The loonie, actually, let's have a look. Do we look at the Canadian dollar? Although it is yet another weak day, last time I checked, for the US dollar, and of course that distorts things. Isn't it interesting, Ed? I don't know if we've heard your view on this. The apparent sell-off, I mean, the buyer strike in US bonds last week, that alarmed quite a few market players, including President Trump, apparently, investors dumping US credit.
Well, there's an old saying in the markets that markets will find the point of maximum pain and test it. And when the Treasury Secretary came out that day when, I think it was the day before they put the pause on, and, bond yields were down because bond yields were inferring lower growth, right, 10-year yields, but the S&P 500 was down a lot. And the Treasury Secretary came out and said, you know what, S&P 500 doesn't really matter. It's really 10-year yields. Well, they put a target on the back of 10-year yields. So the next day, what happened? Everyone started selling that. It's the old, do I have your attention yet? And the market participants were saying. And so, I think it's almost as simple as that. But right now, I think, the issue with these terrible trade policies, nothing more I can say than that, is, it's inflationary, which is bad for bonds on the one side, but, bad for growth. And so it's stagflationary. And so what is the bigger order effect, and how does the central bank respond? And I think the markets are a bit confused. The bond markets are a bit confused about exactly which one's which. And it's really hard to say because every time you walk in, there's a new tariff. Oh, but there's an exemption. Oh, there's a pause. Oh, there's something else.
Right.
And I think that, and the one thing you can bank on is that is bad for sentiment, both consumer and business. But how could a business plan if Trump's goal is to reshore manufacturing, and these plants take years and years to build and decades to pay off? I mean, but you don't know what the policy is going to be tomorrow. How do you make that? How do you do that, right? And I think at some point the market will impose discipline on him and his team, and we will find some clarity. But at this point, there's just not a lot of clarity, and that's where we stand.
I mean, because you could argue that it's an illusionary goal trying to turn America into a manufacturing powerhouse again.
Yeah, I think it's kind of an old school way of thinking, I would say. I'm trying to think of the word, but I can't really quite grasp it at this point.
Antiquated?
Antiquated, that's a great word. But I mean, you think about it, you think about the old Ricardian school of thought when it comes to trade, international trade, and where do you have the competitive advantage, or the comparative advantage, I should say. When it comes to manufacturing, I think it's quite clear, right? If we look at who can produce the goods at the cheapest rate, the most effective rate, it's not the United States, right? Instead, the U.S. is better served over the long term, focusing on other areas, developing its service base more. And that's what we've seen over the past several decades, right? That doesn't necessarily, I think, factor much into the thinking of the Trump administration. But let's say they are successful. Some of those manufacturing companies or firms or processes are onshored back to the United States. To me, that doesn't necessarily portend to an uptick in manufacturing employment to the degree that we saw in the 70s and 80s.
It'd be so automated.
It'd be automated. Right?
Yeah.
Exactly. I mean, this is where you tend to see more deployment into artificial intelligence. But again, these are theoretical concepts, theoretical ideas at this point. Whether or not it's going to play out, who knows? But again, we talked about the pain threshold for the economy. I think that's where it is. I don't think you are going to get, firstly, the complete reshoring of manufacturing capabilities to the United States. But correspondingly, I also don't think employment's going to pick up alongside it if you do.
Ed, Tiff Macklem has said pretty clearly, and I think Jay Powell has said the same thing, that monetary policy is not really the tool to deal with disruption in a trade war.
Correct. But, they got to do something, right?
Yeah.
So, the monetary policy sits there and says, what's fiscal policy, which is beyond their scope. And so they're going to wait to see, we've got an election, we'll figure out who's in charge and what they plan on doing. Then they can look at what's going on with the economy, and the economy is going to be driven by sentiment. That always has been, business and consumer, and then they'll step in. That's why I was in the camp of they should have cut today, just as more of an insurance policy. But it's not an emergency. And the market's not treating it that way. Right. But that's how the Bank of Canada looks at it. So even though monetary policies, think about the Great Recession, right? Think about the pandemic. Both times interest rates went down to zero, and the central bank started buying bonds, to lower, long-term yields. Was that the right tool? No, but it was the only tool, so they ended up doing it, right?
Right. Yeah. But, so the old every problem looks like a nail. Well,
you have a hammer.
You only one tool. Yeah.
Right.
So the Bank of Canada is coming out with two sets of forecasts. One, if tariffs are negotiated away, but the other that we get a significant recession, and they have a scenario here that the economy could shrink for a year. That's pretty nasty.
I mean, it does make sense, though, given how much we rely on the U.S. as an important trade partner, and how much, in terms of direct jobs, are related to trade with the United States, and also correspondingly indirect jobs that also come through from trade from the United States. So, it wouldn't surprise me at all if we do see a significant period of negative GDP growth, and if that portends to, say, a year. I mean, look, that means that potentially, in addition to fiscal policy, there's a good chance that the Bank of Canada might need to get stimulative when it comes to the overnight rate. So they held rates today. That's probably just them deliberating between, okay, what's the near-term pass-through effect from tariffs to higher prices, or retaliatory measures to higher prices, and also weighing the long-term impacts of a lower growth profile, given the fact that, again, you've lost a significant trade partner. Well, not lost, but at least there's trade barriers there that weren't there beforehand. And again, that's something that we need to be thinking about, and think that could be quite constructive for the bond market writ large. And it also potentially means a weaker Canadian dollar.
You mean constructive to the bond market in that people will be buying bonds because, well, equities aren't too exciting?
Or we're recalibrating the bank of expectations for the Bank of Canada lower over the medium to long term. Whereas, I checked the OIS market before I came here, which is what we use to sort of project, where the Bank of Canada's terminal rate is. And I think the terminal rate was priced at close to 225 basis points. Now, that's, to me, is assuming that, okay, there's going to be a significant degree of fiscal easing that's coming through the pipeline in the next couple of quarters. But again, if we're talking about a medium to long-term recession, fiscal easing takes some time to play out in the real economy, depending on what the multiplier effect is. That sort of scenario, does it make sense for the Bank of Canada to keep rates elevated or potentially ease them further? Right? right? And to Ed's point, if you're uncertain, you probably want to start cutting rates.
So they're in their nasty recession, nasty scenario with a recession hitting our economy for a year. They're looking at inflation averaging around 2% until early next year. Mm-hmm. I guess one of their dreads would be that we move towards deflation.
Correct. And again, the zero lower bound, the zero interest rate should be avoided at all costs. And because all kinds of distortions hit the financial markets, the banking system, et cetera, et cetera. So we don't have, the analogy here would be you're driving in the jungle and you hit a pothole and you have to change your spare tire and now you're driving without a spare, right? And you're still going through a jungle. And I think that's what the Bank of Canada is looking at right now, right? So, I think that we don't have too many spare tires. And so we don't want to get stuck in the jungle, which is the zero interest rate trap and a deflationary trap.
Yeah, I mean, it's hard to overstate the drama of these events. We have our prime minister publicly saying the U.S. is no longer a reliable partner.
Right. Yeah, absolutely. I mean, it's quite different than where we've been over the past couple of decades. And, sourcing new markets, opening up new trade relationships, that's not going to happen overnight. There's going to be a painful period of transition.
Bipan, thanks very much indeed. Bipan Rai has been our guest, Managing Director, Head of ETF and Structured Solutions at BMO Asset Management. And then, of course, Ed Devlin, the one and only. Thank you so much, Ed and Bipan. Ed is founder of Devlin Capital, Senior Fellow at CD Howe, former Head of Canadian Portfolio Management at PIMCO. We got to take a break. Thanks again, guys. We are just minutes away from hearing directly from the Bank of Canada. Stick with us.